Okay, thank you very much. My name is Mike Cantwell. I'm with Johnson Capital, and I manage the Colorado office for Johnson, which is a nationwide commercial mortgage banking firm. I'm going to be up here for approximately 5 minutes, and then we're off to something that might be a little more fun. But the glue that makes all of this work is capital. And our firm represents some great insurance companies that are active in commercial real estate lending, companies like State Farm, AIG, Aegon, Allstate, ING, to name a few. And we are pleased to say that we've been quite active this year, and we're very optimistic about the coming year or two going forward. I'm going to take just a few minutes to talk about where we've been and, more importantly, where we're going to be going in terms of availability and cost of capital. There's some good news stories and some stories that aren't so good, but with any of these stories comes opportunity. So what I'm going to try to do is present some trends and some facts, and hopefully you can see where the opportunities are going to be for the next year or so in dealing with this unusual cycle that we've just been through. So my job is to talk about where the money's coming from. Huh?
It's the down arrow, Mike.
I got it. Gee, I'm disappointed. We had this great little movie bit about Jerry Maguire and show me the money, but we'll keep going. Commercial real estate, all of the debt for commercial real estate is represented in this pie chart. That's roughly $3.25 trillion. And you can see that a large percentage, 45% of the debt that's out there right now, is being held by banks and thrift institutions. A very, very small percentage, 9%, is held by the insurance companies. The CMBS, or the conduit lenders, Wall Street, represents close to 20% of what's out there. And so we're going to take a little closer look at where this debt is being held right now and what that means for capital, for the capital markets going forward. This is just another numerical breakdown of who holds all of the commercial debt, and this is as of the end of the second quarter of 2010. These numbers came out of the Mortgage Bankers Association. This is an interesting chart. Take a look at that spike in terms of maturities. Over the next 5 years, we're going to experience a large number of loans coming due. And that's where the stress is going to be in the capital markets. That's also where the opportunity is. The light blue lines that you can see in some years go well over $300 billion. And that, quite frankly, is well in excess of our system's ability to provide capital as it stands today. This is another interesting chart. This is all of the conduit loans that have been funded. At one time, there was approximately $850 billion of conduit loans that had been securitized. Look at those maturities, and look what's going to be happening in 2015, 16, and 17. Perhaps even a bigger issue here is that 62% of all those loans that are represented by the CMBS marketplace are interest only or have substantial interest only. And therefore, there's been little or no amortization. So there will be some interesting times in the next few years. This is probably the most important chart, and again, I don't like to overuse charts, but you can see that the flows of capital coming in and going out of these various providers is quite striking. When you look at the bottom, you'll see that commercial banking over the first 2 quarters of this year has shrunk by over $50 billion. Now, what does that mean? That means that they are not making new loans and that they're pushing customers out the back door. They're forcing payoffs. They're not renewing loans. And that's an area of great opportunity for us. As of this year, we've seen the return of conduit lending. In February, there were 5 conduits active. In June, there were 12. Now there are about 24. In 2008, 2009, their activity level was virtually zero. In the peak years, it hit $250 billion. This year, it looks like we'll fund somewhere between $8 and $10 billion. That's about 5% of the peak years. The important thing is it's back. People are buying the bonds. There's liquidity in the marketplace. The B piece, the junior piece, is being sold. And everybody's, all of these groups that are active again are trying to load up on personnel and in systems and get back in the game. It's going to be quite a while, though. I think next year the forecast is maybe $30 billion, and you can see that's a long, it's a long way from the $200+ billion that was being funded a couple of years ago. Life insurance companies are up 154%, Q3 over last year's Q3. We think that will represent about $20 billion for the year. We also think that next year they will increase their funding by 50%. The agencies, Freddie Mac, Fannie Mae, FHA, are down a little bit. The reason their volumes are down is they're just being overwhelmed. They don't have the personnel available. The backlog is really building up, and we hope that Congress does not tinker with the multifamily side of those groups. Banks and thrifts are off 49%. Again, if you recall the last chart that I just showed you, they're shedding loans. They're not making them. So the outlook for 2011 is favorable for all of these lending sources except banks and thrifts. You've heard the politicians tell you that banks are lending. The larger banks are. The real stress is in the regional and community banking industry, and this year will be a watershed year. I think we're going to see a lot of mergers and acquisitions of these regional and community banks. They're not able to raise the capital. They're kicking the can down the road with their portfolios, and eventually this is all going to culminate in a steady trickle of problem loans, probably over the next 7 to 10 years. For 2011, we're recommending a couple things. One, take advantage of these low interest rates. As was indicated in the buy versus lease panel and earlier in the residential discussions, these are historically low interest rates. Refinance as much as you can now. Borrow safely, do not over leverage, and remember, remember to fall back in love with amortization, because amortization is one of the best things you can have in an investment property. The opportunities that exist are going to be within the banking industry. And if you remember that first slide that I showed you indicated that about close to half of all the commercial loans are being held by banks. And banks are not, for the most part, banks are not lending. They're trying to move all of that paper off their books. So it creates opportunities for something we haven't seen a lot of, but I think we will. We'll see some commercial short sales. We'll see discounted note purchases. I think we'll see a lot of opportunities for those of you who are brokers to list and sell properties, because they won't be able to refinance those properties. And as an investor, I think we're going to see the volume of transactions pick up. So those of you that are buying properties, I think you'll find a pretty fertile marketplace as we go forward. That's really the end of my comments. I'll be happy to take a couple questions if I have any, and if not, let's move on.
Thank you.